Of all of them, there's the debt growth that finances the bubbles that happen before it that create the busts. You know, there's basically 6 stages to it. There's the normal debt growth that finances growth that pays for itself. Then you get into the bubble stage when everybody's extrapolating what happened in the past. So asset prices are going up and everybody's borrowing a lot of money to extrapolate what's happened. And that bubble stage, central banks don't pay much attention to because it doesn't affect inflation and growth. And so I think at that stage is when the central bank should be looking at, are those debts going to be able to be paid back from the financial? That would be the biggest.
Right. And what stage, therefore, are we in today? We had a segment on it around 6:30 with Brian Sullivan, who talked about actually how debt in this country has actually increased since 2008.
Yeah, debt has increased, but debt relative to the debt service payments relative to incomes have not risen like they have had in 2007 and 8. So
his point was looking at corporate debt in particular.
Corporate debt, of course, is levered. But if you look at the corporate cash and you look at the maturity of the debt, when we run the pro forma financial calculations, it's nothing like 2007, what looked like to 2008. There's a squeeze that'll be emerging. But generally speaking, we're in, I would say, the 7th inning of this cycle. I think that we're at the stage in the cycle where interest rates are being raised. Right. We're in the later stage, probably maybe we have 2 more years, I would say, into the cycle, something like that. What? And then the issues of this debt crisis are very different than the last debt crisis. Right. Each one's a little bit unique. This one looks very much more like the 1935 to 40 period.
You mean debt situation? You called it a crisis. We're not at a crisis yet, are we? Are we there now?
No, but
you mean the debt situation?
Can I describe the parallels?
Yeah.
Because I think the parallels are really important to understand. Okay. 1929 to 32 and 2008 to 2009, we have a debt crisis and interest rates hit 0. Both of those cases, interest rates hit 0, only 2 times this century. There's only one thing to do next, and that is to print money and buy financial assets. So in both of those cases, that's what the central bank did, and they pushed asset prices up. As a result, we had an expansion, we had the markets rising, and we particularly had an increase in the wealth gap. Because if you owned financial assets, you got richer. And if you didn't, you didn't. And so what today we have is a wealth gap that's the largest since that period. The top 1/10 of 1% of the population's net worth is equal to the bottom 90% combined. You have to go back to 1935 to 40. As a result, we have populism. Okay, populism is the disenchanted. Capitalism not working for the majority of people. So we have that particular gap. So we have a political gap, a social gap in terms of the economics, and we're coming into the phase where we're beginning the tightening cycle. 1937, we begin a tightening cycle. We begin a tightening cycle at this point. No tightening cycle ever works out perfectly. That's why we have recessions. We can't get it perfectly. So as we're going into this particular cycle, we have to start to think, well, what will the next downturn be like? We're 9 years into this. As you have a downturn, I believe that there's a political and social implications to that related to populism and less effective monetary policy. There's less effective monetary policy because so far there are 2 types of monetary policy used. Lowering interest rates. We can't lower interest rates. And the second is quantitative easing, and it's maximized its effect.